about to drop the hammer and dispense some indiscriminate justice.
Welcome back to Strongman Personal Finance. I am Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon for $3. And partial hater, not absolute hater, but partial hater of using dividend stocks to generate retirement income. Now, if you're retired right now and you're living off dividend stocks and that's how you support yourself, whatever. It's not the end of the world, okay? But I think there's a better way to generate retirement income for yourself, and you don't have to buy a bunch of dividend stocks. Now, I'm going to show you what I plan to have for retirement, and of course I may juggle this around. This isn't like carved into, the tablets on Mount Sinai or wherever Moses went. This is kind of my general idea of what I want to do when I retire. And I'm going to show you why you don't need a heavily dividend concentrated portfolio in retirement. You can literally keep VT, the Total World Stock Market Index ETF, your entire life, and all you have to do is throw in some short-term bonds and some cash into your retirement portfolio, and you can sustain yourself using the 4% rule, which means you withdraw 4% every year from your portfolio, and sustain yourself as long as you need to. Now, in this scenario, I'm going to assume that we have a $2 million portfolio that is not dividend specific. Yes, I know VT pays a dividend, okay, because it's every stock in the world. And of course, a ton of those stocks pay dividends. But what I'm saying is you don't need to have a 100% dividend focused portfolio where you're buying a bunch of high dividend paying stocks. Now, this is a $2 million portfolio, and we're going to use the 4% rule. So if you withdraw 4% every year from a $2 million portfolio, assuming that this stays consistent in the next 20, 30 years, depending on future returns, inflation, all that good stuff, you can roughly generate $80,000 a year of income. Now, this is going to be tax-free, at least from my end, because I have the vast majority of my savings in a Roth IRA. So when I sell $80,000 of stocks or bonds or whatever I'm selling in my IRA, that $80,000 is going to be tax-free. It's not going to be taxed. And then I'm just going to take it out of my retirement account and transfer it into my savings account. Now, we're going to have 1 year of income in a savings account. So every year, my plan is to pay myself $80,000 a year, or $6,666 per month. So I'll literally have $80,000 sitting in my savings account. And then every month on the 1st, there's going to be an automatic transfer, automatic draft of $6,666 into my checking account. Do you see how I can completely control what I'm putting into my checking account every single month? If I need more, well, crap. Okay, maybe I'll transfer $7,000 and maybe I'll do $6,000 the next month. But I have complete control over exactly how much I can, generate or give myself or pay myself an income to retire. Now, you compare this to a dividend portfolio. Let's say this is like 100% dividend stocks, or maybe, this is VT. Instead of VT, you have like VYM, or maybe just a bunch of dividend stocks, and then you have short-term bonds. Well, the problem with that, in my humble opinion, is that the dividend date, the dates the dividends are going to be paid are random. The dividends might be every 3 months, it might be every 6 months, or if you have a bunch of stocks, you might have dividends in March, and then a bunch of dividends in May, and then some dividends in December. But it's all kind of random because each company pays dividends on different dates. Whereas if you do this method, you can literally control the exact flow of income at any one time. You don't have to wait around for a dividend to come in to fund your retirement. I think it gets a lot more difficult to juggle and make things easy on yourself if you have a bunch of dividend stocks in your retirement portfolio and you're collecting a little bit of dividends this month and then a way more this month. It's just madness. Why not keep it easy? Have a portfolio like this, roughly 40% bonds and cash and 60% VT, and you can literally pay yourself exactly what you want by keeping 1 or maybe even 2 years of cash in your savings account. For this scenario, I have 1 year. And then you literally just transfer yourself the exact amount of money you need to sustain yourself in retirement. I don't have to wait for a dividend to be paid out to get this $6,666. I got $80K sitting in my savings, and it transfers in every single month. Do you see why that's a lot easier, ladies and gentlemen, as opposed to dividend stocks? Now, I know a lot of you love dividend stocks, but in my humble opinion, I don't like them. I think they're tax inefficient, and I think they do nothing except make you pay more taxes. You can disagree, but compare your plans to retirement to this. This seems really simple. I have money sitting in a savings account, and it gets transferred every single month. A portion gets transferred every single month into my checking account. Now, for the remainder of my portfolio, I'm going to have 9 years in short-term bonds. The reason I have this is to give some stability to my portfolio. For example, if you had, let's say, 96% VT and 4% cash, well, if the market tanks, if the world market tanks, you're going to really have to dip into your principal to fund your next year of retirement. But if you have 9 years in short-term bonds, these are not very volatile. These are going to basically, roughly stay the same even in a market crash, or even go up a little bit in a market crash. By having this 9-year cushion, if there's a market downturn for even a couple years, you still have 9 years of, basically stable money that you can withdraw from until the market recovers. In addition, these short-term bonds also give you the chance to basically buy the dip. I'm not talking about me, Kevin's buy the dip. I'm talking about actually buying the dip. If, let's say, the world market crashes 20, 30, 40%, you can use these bonds to buy into VT at a low to reallocate your portfolio. So that's why we have these short-term bond here. It's for stability, and it's there to help fund your cash needs in case there's a multi-year downturn in the stock market. Now, the 60% VT is to kind of make sure your portfolio grows enough to where you can actually withdraw 4% per year. Because you want your portfolio to be stable enough or not go down so that you withdraw 4% per year and it basically stays the same and you never run out of money. And of course, you can adjust that if, market conditions change. But this is kind of like roughly what I want to do with my retirement. So you can kind of see why I'm so big on tax-advantaged accounts. I'm going to have a ton of money in tax-advantaged accounts. I can withdraw X percent, 3-4% per year. I pay zero tax because it's already been taxed before I put it in the Roth. I have a year or maybe even 2 years of cash in a savings account, and I can pay myself whatever I need every month with an automatic transfer. It's like a paycheck, boom. And on the first of every month, you check your checking, and boom, there's $6,666 in there. And then that's what you have to live on that month. And then I have 9 years of short-term bonds, buy the dip, cover my cash needs in the event of a market downturn. And then I have 60% total world stock to kind of sustain myself. But I don't need dividends, okay? I don't need to have this massive, complex dividend portfolio. I could literally have 2 ETFs and just literally do one thing a year, transfer money from short-term bonds to cash, and maybe a little bit from VT into short-term bonds, depending on how the market's doing. And that's all I have to do, one time a year. And I can completely control when and how often I get my money instead of having to wait around for dividends, okay? Now, I'd love to hear your opinion. You can disagree with me, and that's fine. But I think this is the better method instead of buying a dividend portfolio and living off the dividends. Anyway, that's it. Like, subscribe, tell your friends about me. You have a wonderful day.